presentation proper, I actually wanted to show this slide. It's a little bit dated, end of September, because when I put out these slides and also write the fourth quarter review, is actually at that point in time. But what I want to show over here is actually 2 points. One, which is that, if you take a look at these the two lines over here, one red and one in blue. The blue is actually US market S&P 500, and the one in red is actually ACWI, which is a MSCI World Index. I just want to draw your attention to how closely these two lines actually track each other. And actually, subsequently, after end of September, there was actually a slight rally in the both charts itself, and they track very closely to each other. So the point being that actually, whatever happens in the US at this current moment is actually driving share prices, right? So that's first thing. That's why they correlate so well. So this is something that we have to figure out, when we look at the risk asset. The second thing is actually I want to draw your attention to that in a bear market, there are also rallies along the way. So if you look at the chart itself, it looks like it's on the way down, but along the way, let's say if you look at June, right? I have a fairly bearish, should I say, newsletter, and even during the show, I was like fairly bearish, right? I said, bearish times ahead, but the market actually rallied, I guess, for around 20%. So it was actually a good opportunity for people to rebalance and actually to park their money into selective investments opportunities, right? So next slide. Okay, so over here, I just wanted to break it down into two simple stories, for the next 6 to 12 months ahead. What are the two stories that I guess investors got to ponder about? Is the first, like just now I've actually mentioned that actually the world market follows what the US stock market does. And why does the US stock market move in a certain ways is because of this anticipation that the Federal Reserve or the US central bank will actually pivot. So what does pivot mean? It means that, just now I've actually mentioned the tightening cycle, or should I say, let's say, for example, the interest rate increase this year has actually caused risk assets to come off, right? So to cause a correction in the US market. So this expectation that the Fed has finally had enough, right? They have done enough. They feel that it's time to slow down or stop rate increase. And if not, going forward, maybe to cut rates. So this is the moment that actually investors are looking for. And obviously, if the Fed pivots, the stock market would actually have a tailwind. So in June of this year, just now in the previous slide, you actually see that the stock market had a 20% rally from June. And then subsequently in August, September period, when they see the CPI numbers, which is actually inflation numbers, come out fairly strong, then the market gave up the idea that the Fed is going to pivot soon, and it actually started to correct. And this time around again, the market is actually starting to rally again. So there are two issues over here. One, which is actually to anticipate when the Fed is going to pivot. But that said, the US in the US market, they have hiked rates very strongly for the most of 2022. There are some expectations that in the month of December, there'll be another 75 basis point rate hike. Next year, maybe another 2 more rate hikes. And by March, April period, we are almost done. So in a way, the whole rate hike cycle for the US is probably coming to an end, closer to first quarter of next year. The second story that I want people to actually to pay attention to is this question about, when the Chinese growth is going to come back. This has implications for the Asian market also, right? So it's not only implications on China, but also on the Asian market. And I have actually good news for the listeners here. The two key issues that are holding back the Chinese market are first, the zero COVID policy, i.e., if you are very tight, do not allow people to go out when there's an outbreak of COVID, then obviously the economic growth is going to be slow. People are not unlikely to buy things, unlikely to buy property also. And the second issue over there in the Chinese market is actually this slowdown in the property market. There's some distress over there. So this actually caused the Chinese market to correct much earlier than global equities, i.e. in the Chinese market, it's already corrected for 2 years. And we think that, we are, at a very good position, whereby any good policies that comes up from China could actually lift the Chinese stock market. So next slide. So actually, before that, I think we can't talk about the equities market, without looking at the valuation and also the earnings growth itself. So I have over here a table, and the table actually shows the key major markets out there: US, Europe, Asia Pacific, China, and Singapore. What I want to draw your attention to is that, if you look at the valuation itself, if you use a PE ratio, a price earnings ratio, right? Most markets are actually trading at a discount vis-a-vis historical average, but or at least, at a lower end of it. But the US market relatively is the most expensive among all the regions out there. And secondly, if you look at the earnings growth, the earnings growth expectations for most markets are still fairly high. So if you look at in the US market, in 2023, the earnings growth expectation is around 6%. It could have been revised slower, but it's still on the high side. So if you think about it, my title of the slide actually says that the valuation seems reasonable because, like I mentioned, is on slightly cheap on the historical basis. But if you look at the earnings growth expectation, it's still too high. I.e., in 2023, when when economic growth actually slows further, let's say we have a soft landing or even a hard landing for, let's say, the US economy, we would expect earnings growth to be much lower than this expectation, i.e., in a contraction, you could actually have negative earnings growth, meaning that this earnings growth expectation for next year could be too high. And this revision lower could actually be a drag on the performance of the, let's say, the US equities market. Next slide. And actually, sometimes, investors actually do compare the attractiveness of, let's say, the stock market vis-a-vis the bond, right? So if you look at this, there are 4 charts over here. On the left, top left is US, then you have Europe, and on the left bottom, then you have Asia, and also, I guess, is Japan on the right-hand side. If you look at this over here, when the line is trending down, it actually means that the bond market, or should I say bonds, are actually more attractive than stocks in the particular market if you compare dividend yield vis-a-vis the yield that you get from the bond market itself. So meaning that in US and in Europe, investors actually got a better choice, i.e. to buy bonds than to buy the equities. So there's this, shall I say, handicap, in markets like in the US and in Europe, whereby investors could actually, find a better valuation buying, bonds vis-a-vis, taking the risk and buying equities over there. So i.e., there's a natural headwind for stocks in the US market and also in the European market. But if you look at Asia itself, it's actually fairly priced, right? So i.e., you don't actually have this issue. Next slide, operator. Okay, so next, I think very quickly, I just want to highlight, should I say, 3 opportunities out there that investors could actually consider. But bearing in mind that, my, should I say, outlook is for a 6 to 12 months basis. It's very difficult for strategists to actually to time market, given that it's actually very volatile. So there are actually, should I say, 3 opportunities out there that investors could actually consider. One, which is actually the Chinese stock market. So over here, I just want to show MSCI China, right? And the chart actually shows that the Chinese stock market has actually corrected over the last 2 years. Next slide. And there are, just now I actually mentioned 2 reasons why it actually corrected. One, which is actually the zero COVID policy out there. But I have good news. On the 11th of November, the Chinese National Health Commission actually announced a set of rules, right? They have not completely reversed the zero COVID policies over there, but they have actually loosened up. So i.e., for example, minor steps, right? They relax the quarantine conditions, contact tracing, testing, and so on and so forth. So this is actually a good sign. Our expectation is that over the next 6 months to 12 months, as the vaccination of the elderly actually rises to a comfortable level, the Chinese government will also be more comfortable to actually relax a number of these policies, which means that the economic growth in China could actually recover. Next slide. And the second thing that has been weighing down on the Chinese stock market is actually the slowdown, or should I say, the issues in the property market itself. And for this, again, on the 11th of November, the PBOC, or the People's Bank of China, and also CBIRC, they have actually announced, a set of very comprehensive measures, 16 of them actually, to try to support the property market. So over here, you have a whole series of measures that actually takes into consideration, helping with refinancing, helping with the so-called completion of the project itself, also helping with, let's say, M&A, so that, the stronger companies can take over the weaker company, and so on and so forth. So we are actually seeing the early green shoots of a recovery in the Chinese economy. So for that, I think after 2 years of correction in the Chinese stock market, we are at a stage whereby valuation is actually cheap enough, and the positive policies that are being announced could actually, help be a tailwind for this market. Next. The second opportunity that I want to mention is actually the Singapore stock market. The Singapore stock market has actually relatively outperformed the rest of the Asian market itself. We think that there are a few positives out there. One, which is that Singapore has become a safe haven for funds flow. This is after a very positive way in which the Singapore government has actually navigated the COVID situation. It has actually caused many of the companies to actually set up, let's say, headquarters, regional headquarters, and even for funds flow to start coming to Singapore. So that actually is a positive for the Singapore market. Second thing, which is that the Singapore market actually has a value bias to that. And actually in an inflationary environment, it actually benefits from it. So next slide. Over here, I just want to show that in the Singapore market, the stock market, there's actually a so-called roughly a 10-year cycle. And it actually tracks how, it actually does better when it's actually inflationary, and does worse, when things are actually deflationary. And we are actually at the start of an inflationary cycle. So over here, I shall not elaborate more, just to show that, it could actually be a tailwind for the Sing market. So the relative performance of the Sing market at this stage, at this point, could actually continue. Next slide. And this one, just a interesting article, or should I say diagram, to show this wealth flow into the Singapore market. I think a lot of the listeners who are based here in Singapore, they would have experienced it themselves. Property prices actually going up, rental going up, COE, which is the car prices, are also going up. So this is part and parcel of the wealth effect over here. Yeah, next slide. So Singapore is actually quite a defensive market, even if we actually have a slowdown in global economic growth. The third opportunity that I want to talk about, and this could actually be slightly controversial, is actually Japanese equities. Not something that investors would be naturally inclined to, but I just want to point out that Japan is at this pivotal point. After 40 years of strong yen, you actually see yen actually weakening to a 40-year low. A lot of our listeners probably are planning, or if not gone to Japan for a tour, right? Because the Japanese yen is actually so weak. But I just want to point out to investors that not only does actually Japan appeal as a tourism spot, but also with a weak yen, Japan could actually become very competitive. Next slide. So historically, if you look at this chart over here, I just want to show two lines. One, which is Nikkei 225. This, of course, is the Japanese market, and the other one is actually the yen. So as the yen goes higher, means it gets weaker. As you can see over here, there's actually there's a correlation between yen and the market, meaning that when yen weakens, the market tends to do well. So I just want to highlight to investors that this is something that is not shall I say, not commonly recommended or by investors, because the Japanese market has not done well for the last 20 to 30 years, right? But I just want to say that we could actually be at a pivotal point, because with this yen weakness, the Japanese market could actually be very competitive, and you could actually have all these structural, shall I say, trends that could actually happen in the future. For example, onshoring, i.e., when things are so cheap, and wages are not really going up in Japan, some of these companies could actually consider moving part of the manufacturing back onshore into Japan itself, and we could actually see a reflationary cycle within Japan. So finally, next slide. Very quickly, I just want to maybe summarize my views over here. A very simple view over here that is probably negative in the short term for global equities, especially in the US, as although we are coming to the end of the rate hiking cycle, but it still probably continues until first quarter of next year. In the developed markets, also because of valuations and what have you, and the weak economic growth, Europe is also not a good choice. We have actually highlighted three so-called opportunities that investors could actually look at. One, which is China, which has corrected for the last 2 years, and we are finally seeing green shoots, i.e., positive policies coming out from China. Second, Singapore is a defensive play because you have all these funds flows coming into the Singapore market is actually being deployed in the property space. It benefits the banks over here, which are a big part of the index itself. And the third one is actually the Japanese market. As the Japanese yen actually has weakened to a 40-year, shall I say, high or low, the Japanese market could actually be a very competitive, or the Japanese economy could actually be a very competitive economy, and as such, you could actually see selective or good opportunities over there. So I should end at that. Next slide. Just want to okay, if you want to contact us, this is our address. And last slide. Next. Yeah, this is a disclaimer. Okay, back to you, Olivia.
Thank you, Yin, for sharing your key insights. And I would like to probe further with some questions that I have in mind, especially related to your presentation. So, do you think that there is a trend of deglobalization, and how do you think that could possibly affect the Singapore equity market?
Well, I think this is a very complicated story itself. In this deglobalization world, if you ask, are we in a globalization or are we in a deglobalization? Well, I think it's fairly clear that we are slowly in a deglobalization world, right? So you although in the especially if you look at the relations between, let's say, US and China, and then in the US you have this block of nations where they're trying to actually be self-sufficient at their side, and the Chinese side is trying to be self-sufficient at their side. And you have this whole group of countries, including Singapore, who tries to be neutral and be the middleman to these two blocks. I think this deglobalization trend is ongoing. When that actually happens, there are actually winners and there are opportunities also, right? So I would say that for some industries, some companies, let's say US, European companies, they could be actually considering that, should we actually, consider, let's say, if I have a manufacturing hub in China, obviously I still do, right? Because the Chinese market is a big market. But for exporting purposes, do I have to consider a separate location altogether? So areas like, let's say, India, obviously, Vietnam, right? So these are actually, they call it China plus one, right? These are actually areas whereby, these companies will be considering setting up their, their manufacturing arm, a separate manufacturing arm. So there could actually be opportunities over there, and actually for investors, to identify the companies that would benefit from this. You would actually see, there's alpha, basically, there are opportunities over there. Second thing would be in this deglobalization world, so just now I also mentioned, right? You could also have a need for a neutral location, right? So in Asia, let's say, if you look at Singapore, Singapore is now becoming should I say, a financial hub for the Asia region. So you could actually see funds flow coming to Singapore. I don't have the chart over here, but over the last 2 years especially, you could actually see a huge increase in let's say family offices setting up here in Singapore. So
Absolutely.
so there are actually opportunities when these should I say, these locations are happening. Does that mean that it's always negative for the countries? Let's say for China, it's also not true, right? Certain sectors would actually benefit. So for example, when the Chinese are talking about self-sufficiency in, let's say, semiconductor, there are certain supporting industry, components, right? Equipment manufacturers within the Chinese ecosystem. They'll be facing let's say, a windfall, because let's say the chip manufacturers that in the past buys from other countries, now they have to source internally. So some of these local manufacturers would actually see an influx of orders, and that actually be positive for their share prices also. So I'm just saying that in volatility, there are always opportunities. So I think it's good for investors to actually to bear that in mind, that it's not all negative, it's not all bad. You actually really got to take a close look at it. Pick up all the knowledge, and you probably will be able to benefit from it. Back to you, Olivia.
Thank you, Yuin. So currently the T-bill and the bank's term deposits offer very attractive yield, right? And the yield topic is recurring on all our discussion channels. Now, why should we still consider equity in our investment for that case?
Well, for one, I think I do not dispute that, let's say in the Singapore market, right? Since our audience will mainly be logging from Singapore, if you look at let's say the Singapore T-bills 6 months, it hit a high of 4.19 or thereabout, percent return. It's gone off now to maybe 3.9 or thereabout. Our expectation, is that probably strong demand, and also expectation, because expectation that after rate hike to a certain level for next year, end of next year, maybe that there could be a possibility that rates to actually be cut. So I'm just saying that in the meantime, you actually have a good use from T-bills, but going forward, the rates could actually may actually peak off, and you may not get that kind of rates going forward. That's one thing. Second thing is that, of course, there's no growth, right? When you buy T-bills, you get a fixed return. But for equities, when valuations are low enough, then the upside could actually be higher than what you get from T-bills. But I do say that for all investors, they should actually take a look at their own personal risk profile. It's good to have a diversified portfolio, i.e., a portion of that in equities where you can actually enjoy potential growth if let's say the valuations are low enough, there's actually earnings growth. You should actually have a portion of your let's say your portfolio in that. There should be a portion of portfolio in, let's say, in fixed income, and also in cash equivalent. So depending on the so-called the risk profile of the investors, I think it actually pays for them to actually have a diversified portfolio.
Thank you for that. So which sectors will particularly benefit from China reopening? So, everyone's watching China, and of course, in light of recent events, the past few days, things are looking a little dark and bleak at the moment for a lot of investors. So, what can we look out for, and which sectors will benefit from, the reopening next year in 2023, possibly?
Well, I think it's not a full 12 months kind of a time frame, because the market now is a very volatile market. In
Right.
fact, although the market has actually correct, let's say if you look at the Chinese market, it has corrected over the last 2 years or so. But I think in the month of November, because of this anticipation of a reversal of the zero COVID, and then also because of this announcement of the support of the property market itself, I think the Chinese market has actually rallied quite nicely in the month of November. So there are actually short-term opportunities out there that and if it rallies very strongly, then it's time for investors to take some money off the table itself. So in a shorter term, I've actually just now mentioned three opportunities out there, right? I think the Singapore market probably is something that is you have to take it with a longer term. Japan is an interesting market. It hasn't started running yet. It hasn't. When we did, we think that the earnings over there would actually be fairly strong because let's say the weak yen, the full impact of the weak yen hasn't been felt yet. Some of the companies out there actually hedges the FX or the foreign currency exposure. So once the contracts actually roll over, you could actually see the impact of the the weaker yen, i.e. if it's an MNC, right, earnings from overseas gets repatriated back to Japan at a much higher local currency, and you should see a stronger I say earnings, so that you could actually see opportunities for the stock market to go up. For China itself, in a shorter term, you could actually see the rally continue. The reason is because of this loosening, or should I say, these positive policies that are coming out from China. But as with all things, sometimes it doesn't go in a straight line, right? So, for example, the zero COVID policies that they have, I think the intentions are there, right? They want to give ample time for the elderly to get vaccinated before they actually open up. But at the same time, and their intention is actually to open up, because to do so means that there'll be economic growth in China. But as they do that, the new cases actually will climb up. Just like, in Singapore, we actually experienced that, right? So when the new cases goes up, the government will say, I think, it's gone up far enough, let's tighten a little bit, or let's be more cautious. And then, the cases comes down again, and then they reopen. So it will be this process. And actually, I want to draw listeners to our experience also in Singapore. It's the same thing whereby in Singapore, we were earlier in actually opening up. And as we open up, the cases actually climb up, and then we tighten a little bit, and then it goes off again, and so on and so forth, right? But eventually, in Singapore, things are back to fairly, a normal state, vis-a-vis, almost back to pre-COVID days, right? So yeah, so I guess there are actually opportunities out there. Sector-wise, there will be certain sectors that will actually do well. Let's say in the Singapore market, if you look at the banks actually have got fairly strong fundamentals. If you look at the third quarter earnings, the three local banks have got fairly good earnings, right? Net profit after tax, I guess it grew by, I can't remember, but 30+%, I think, start 30, ish thereabout. The reason behind that is because the economy is still strong, right? So credit costs, meaning that non-performing loans, are not climbing, right? So the economy is still fairly strong. The rate hikes have actually allowed the banks to charge more in terms of loans, right? So which means that the net interest margins are actually getting better, meaning when they lend to lend out, they lend a higher rate. The deposits, they are giving out a higher interest for deposits, but not, this is the funding cost, right? But the rates are not going up as quickly. So meaning that spread will actually widen, which is actually positive for bank earnings. So I mean, in an inflationary environment where rates are actually going up, it doesn't mean that all sectors suffer, right? So some sectors, like let's say financial sectors, actually do fairly well fundamentally. Yeah. So there will always be opportunities, right? Yeah. So back to you.
I think that's a great way to round out the discussion for our fireside chat, because we've got a lot of questions already coming in for Yuin, and thank you for the audience questions, because these are the questions that, of course, we want to ask as well. If you don't ask, I will probably ask them anyway. So thank you to the people who are already writing in to Yuin. We will answer those questions at the end. But for now, I do want to do our first giveaway to thank you for being here with us. Yuin will be back with you shortly. All right, to everyone watching, you're here with us. We're here to reward you, and I hope you've been listening. We're going into our giveaway. Now, here are the mechanics for it. So if you could just show me the rules for the audience, this is how it works. All right, so you got the 5 first people, and the right answers will stand a chance to win some rewards from us. It's listed on the screen. And of course, I think it's going to be quite valuable for you in the community space, especially if you're, these avid fans of Moomoo itself. All right. So I hope you get it. In 3, 2, 1, here is the first quiz question. How many times have the Feds raised rates in 2022? You should know this. How many times have the Feds raised their rates in 2022? What do you think? Fastest fingers first and the right answer. Yes, you're very quick, everybody. Okay, it looks like we have our winners. Congratulations to all winners. The team will be in touch. Okay, so before we go into the live Q&A and the second giveaway, I would like to show you how you can actually apply what you learned from today, from Yuin's insights. And of course, it's about being strategic. It's about being selective today. So this is how you can proceed. If you open up your phone, the page should look like this. Click on Money Plus. If you click on Money Plus, you go to Fund Houses, right? The icon is staring at you right there. And it's on the right-hand corner. Click on that. And for the purpose of this, of course, you want to go for Lion Global Investors, okay? So if you scroll down, you can see right there all the available companies that we have listed on the app. You click on Lion Global Investors, and it should take you to this page. Okay, so this page is important because it gives you the details, but it also outlines all the available funds and types, and also the returns, the yields, and all the important information you need to know about the particular fund. Okay, so let's say we choose Lion Global Singapore Trust Fund. Okay, so let's click on that. We click on that. Here are all the information and all the tools that you need. I know it's quite detailed, and I think that is important because for me, I work with detail. I need to know as much as I can before I make an informed decision and to improve my overall investment strategy. So over here, you've got the trend charts, NAV, you've got also the live data, just really reported daily within seconds, also updated, and you'll be fed with the information as quick as possible, so that you can make a decision right away if you need to. All right, so the different tabs, you can just scroll, you can just decide. It's all information at the end of the day, and it's data available from us to you, so that you can help yourselves make a decision. So I like to use news analysis. So analysis is one that I use quite a lot as well. And it's a lot of information. It's comprehensive. And that's what I like about this. Now, if you've decided, let's say if you want to go with this fund, you just go to that bright orange below, just staring at you right there, click on it. Yes. So click on that bright orange and it takes you to the subscribe page. So it's very straightforward and very, very fast at your fingertips. You can just input a minimum of 100 Sing, and of course you can go way beyond that, but that's just the minimum they allow, and it will tell you what you can and cannot do. It will tell you what's the available amount you have, and of course you can decide from there. Yeah, so then you can decide to subscribe once you're ready, and you can also change the product name accordingly. So of course you go back to the previous page, right? You can see right here, if you want to subscribe to any other Lion Global funds that we have available. All right, so I hope that was helpful for you. Don't worry, the team is on site. Type in your questions in the in-app. They will contact you and we'll leave an email towards the end so that you can ask further questions. Okay, now quiz giveaway 2. That was quick, wasn't it? All right, so fastest fingers first and the right answer. Okay, the first 5 who actually get this right, you will walk away with a gift from us. Our way to reward you for being here with us. Quiz number 2, are you ready? In 3, 2, 1. Let's show the question. Is it true that the difference in interest rates between Japan and the US has caused the yen to decline? What do you think? True or false? Okay, you guys are very quick. I don't even need to repeat the question. Amazing. We got our winners. Congratulations. Our team will be in touch, okay? As well as our previous 5 winners. So congratulations to all 10 of you. All right, stay tuned till the end if you still want to win, because we got a final question at the end of the Q&A. Could I please invite Yin back onto the floor, please? We've got a lot of questions from the audience, and I would like to go straight to it. Hi, Yin.
Hi.
Welcome back. All right.
Sounds
So
like fun over there.
yeah, that was fun, wasn't it? It's always great, right, with these interactions. And also, you want to know if you can test their knowledge a little bit. And of course, no problems at all.
Yeah.
The audience always gets it. All right, so Yin, I would like to ask the first question. And I think it's also quite important to kickstart this whole live Q&A.
Sure.
Maybe you could start with, how do you think for next year, how will the interest rate hikes by the Fed further affect Asia? Let's keep it macro.
Okay. I think the expectation out there in the market, December, another 50 basis point. Let's say February, there's another 50 basis point, and then another. I guess this is where the contention is, whether in March we still have one more hike. So let's say 25 basis point. So it probably ends there, right? I think the Fed's expectation is also that, after that, you will be flat. But for the Asian market, the rate hikes, the inflation actually in some Asian countries is actually delayed. It's a delayed onset, and they have actually sort of held back in raising interest rate until the very last minute. And so our expectation is that some of these rate hikes in the Asian countries will continue, even after the US rate hike has actually ended. Let's say our expectation is probably in March there's one more and then it ends, right? So some of the other countries out there in Asia could actually raise rates beyond that, i.e. You'll be a delayed one going into that. So well, I think that's our expectation. Just now I think in your quiz you have a very interesting question. You talk about is this interest rate differential one of the reasons why the Japanese yen is so weak. I guess I think that should be the case, which also means that I guess I think maybe take a step back. You actually see the US dollar strengthening a lot vis-a-vis almost every other every currency out there for this year. And the yen is actually has actually weakened quite a fair bit, the euro and so on and so forth. And the main reason is because the US central government has been most aggressive in actually hiking rates, right? And actually a strong dollar is weak, is actually negative for Asian stocks by and large. It's actually a headwind. Our expectation for next year would be that since the rate hiking cycle for US is actually coming to an end, and then subsequently some of the Asian countries could actually continue to rate hike, and at least this differential is not widening, right? So our expectation is that this strong US dollar trend could actually take a breather, in a first half of next year, i.e., US dollar wouldn't strengthen so much. And then in the second half, of the year, there could actually be expectation when the US economy slows down quite a fair bit. There could now a reverse, right? Expectation that the US central bank could actually cut rates maybe fourth quarter of next year or maybe later. And that could actually cause the US dollar to weaken. But in the meantime, because of the interest rate differential between US and also the other countries, although it's not widening, I guess it wouldn't the US dollar wouldn't weaken so fast. And that could actually be positive for equity prices here in Asia.
Mm-hmm. Thank you for that. Next question. The 10-year and 2-year US Treasury yield curve inversion has already occurred many times this year. So is there still a need to fear recession going into the new year?
Well, the 2 10s in the US, is one of the indicators out there. Everything is about probability, right? So I think our expectation for next year will be that there's a reasonable risk that the US economy actually goes into a recession. When I say reasonable, I guess it's tough to come to a number, right? When I say reasonable, maybe 30% or thereabout, right? For the whole of 2023. But but if so, this 210 could actually be let's say be an indicator, forward indicator for that. It actually maybe it's just a sign that things are not going so well in the US market. But that said, right, if you look at, let's say, some of the economic data that's coming out from the States, it seems like the economy is still fairly resilient. So the latest, let's say, retail sales numbers is still fairly strong, right? But the fundamentals are actually weakening, i.e., if you take a look at, let's say, the households debt, the debt is actually increasing, i.e., people are actually borrowing to spend because, things are getting more expensive, right? Inflation is on the rise in the US, inflation is high. So people are actually borrowing money to spend, and as such, the retail sales numbers are actually fairly strong. But that is not something that is it's not something that can continue forever, right? So I think along the way, when the debt level gets too high, then obviously the retail sales could actually slow down and so on and so forth. So this is just one indicator, right? I'm explaining to people that there are definitely stormy clouds in places like in the US. But I would say that everything works in a probability, right? From the current data that we see, there's a minor probability that we could actually see a recession in the US for next year. But for other parts of the world, right? Let's say if you look at Europe, it could very well be in a recession already in certain parts of Europe and so on and so forth. So for different countries, they are in different parts of the cycle itself. So you really got to take a look at that. Yeah.
So with that, right, what are the opportunities or at least potentials for any equities to rebound in 2023, or will it be a rollover to 2024?
Well, we are slightly bearish on the US and also on Europe itself. It doesn't mean that everything has to be correlated, right? Because I guess the correlation was very high over the last 2 to 3 years because of COVID. But if you go back far enough, it is some markets are on the way up, some markets on the way down because economic cycles are not synchronized, right? So over the last 2-3 years, it was actually a very special. It's a very special situation whereby all countries got COVID, right? I mean, and all countries actually got into lockdown. And then all countries actually, in a way, right? The governments get worried. They put out measures to actually to help support the economy and so on and so forth. So in a way, COVID has actually synchronized the cycle at that point in time. But as countries actually get out of COVID, certain countries actually open up first, certain countries don't, right? And inflation hits different countries differently. And as such, the monetary policies that different countries actually put out is actually slightly different from one another. So the economic cycle starts to deviate again. So in a way, I mean, it's a long-winded way, of saying that you could actually be bearish on, let's say, US equity, but it doesn't have to be bearish on everything, right? So over here, I'm just saying that the economic cycle over here in Asia could be different because China is the last to actually to open up again. So the economic growth in China could actually, be stronger than in the States, where States is actually slowing. China is now, on a stage whereby it's reopening and the policies have been very tight and now they are actually loosening. So, the cycles could actually be different, right? So, in a way for 2023, just how I mentioned, that's why, we actually put out and say that there are three selective opportunities, right? That investors could actually consider.
Got it. The next two questions, and I've got a few related to this, so I'm just going to merge it together. It's about asset allocation and also which sectors you recommend. So maybe part A, we can go with what sectors, income or growth, would you lean towards for next year? And the second part of the question is, what advice will you give a retail investor for portfolio allocation? So how much percent should I put in equity, ETF, cash, or funds?
Okay, so anyway, is it income or growth or what have you? I think some investors actually look at it as value and growth, right? Value meaning, you look at the financials and, commodities and so on and so forth. These are considered value companies. And growth, you look at the technology space and what have you. I think instead of looking at that could actually be not so relevant in this time itself. Meaning that investors could actually consider, right, having a so-called a little bit of value because commodities are actually doing well. There's still inflationary. You could actually consider in terms of, let's say, a little bit more of this value, but at the same time, you could also consider quality, right? Because like just now, I think you asked a pertinent question, which is that, if you actually have let's say, a economic slowdown in the States, Europe is already in an economic slowdown, it could actually impact, the growth rate, global economic growth rate. We could even have a global recession. Let's say, it's a minor chance, but that could actually happen next year, right? So when that happens, what do investors actually look out for? They look out for quality, right? Meaning the certainty of earning, certainty of income. So I think investors could actually look at having some good value plays, good value plays that actually benefit, and they could also have a basket of, let's say, quality stocks. So this could be a strategy for our listeners because of this volatile environment going forward. The second question that you have, I guess this one is more nuanced, i.e., it really depends on the listener themselves and also on their risk profile. But it's always good to have a diversified portfolio. So, i.e., since T-bills are giving such a good rates, you should have a portion of that. You should have some in, let's say, in fixed income. Actually, for 2022 is a very special year, right? Whereby, let's say Asian bonds and what have you, the prices have actually gone down quite a fair bit. I think if you stretch it back and you look at bond prices, this is probably one of the worst in the last, I don't know, 50 years or thereabout. So meaning that, there's actually significant value over here, and actually investors could actually look at that as an asset class on a longer period of time. And obviously for equities, that gives you the kicker, right? The growth, right? So when things have actually decelerated, valuation has gone down far enough, then equities gives you the kicker, or should I say the extra when things are actually recovering. So it actually pays to have a diversified portfolio. And obviously everything depends on the risk profile of the listeners themselves.
Right. Very important points there. And thank you for highlighting the different elements and angles to it. We've got time for two more questions. And I think these questions I saved till the end because it's quite contextual, but also important, I think, for strategy. So someone wants to know, it says here about passive investing. So I noticed that Warren Buffett kept promoting that as a passive investor, we should keep buying S&P 500, but that's for a globalization era. So now that the new future is deglobalization, should we still keep to the S&P 500? Yuin, what do you think about adding the MSCI or other indexes into our portfolio portfolio for a passive investor?
Yeah, I think this this is something that's been debated quite a lot. S&P, again is this, right? If you look at the S&P 500 only, right? It has done very well over the last I don't know how many years, 50 years, 40 years, or thereabout. But you can also look at it this way, right? As in, this strong performance could also be because of a long cycle, the long interest rate cycle, i.e., in the 70s, rates were actually so high, and then it's been cutting rates, cutting rates, right? So when rates are actually coming off, it's actually positive for stock prices. So we could actually be at a point whereby, we are actually it could actually be at a point that, it is actually turning, right? Meaning that rates could actually be rising, and actually bond yields could actually be on the rise. And, bond yields actually have a fairly long cycle, meaning that, it's maybe 25 years down, then, when it's actually rising, it could actually rise for maybe the next 10 years or so. So, so if you adopt that strategy of just putting all your eggs into S&P 500, maybe, we are at a stage whereby the bond yields are actually on a longer cycle up, and then, you might be catching the S&P at a not a very good, not a good timing. So in any case, I guess it's probably good for us to actually have a diversified portfolio, not just the S&P 500. So just now I've actually mentioned something that's worked for the last 25 years, 30 years doesn't mean that it will work for the next 25, 30 years. Of course, I don't pretend that I'm actually cleverer, than Warren Buffett, but as with all things, you take it as a reference, right? It's important for investors to do their own homework and actually to figure out, whatever that these people say, is it actually relevant in current times? Yep.
Thank you for answering that. Important. I think the audience benefited from your answers and your analysis based on this. Now, for the last question that I've picked out, it's a bit more broad, but someone like to know, with the US-China technological war going on, or at least that arms race towards the future, which equities market is better to invest in going into the new year?
Well, actually, because of that, the Chinese tech space have actually been has actually sold off, and actually there's I will phrase it slightly differently. I will say it this way, right? I think for last 1 year or so, or 2 years or so, right? The tech space in China has actually sold off quite a fair bit, and it's precisely because of this tech war, right? It started with Huawei and then so on and so forth, right? So there's all this negativity with this the sector itself, and actually the beneficiary of it is that the money goes somewhere else, right? So for example, where did the money go to, right? I think part of the money actually flowed to let's say Indian equities, the Indian tech stocks. So, but actually in the reverse of it, if the policies are actually positive, if the relationship between US and China, it won't be such that they will be petty again, right? There will be still this rivalry. But if they can find a means to actually to compromise along the way so that they do not escalate the situation, then you could actually have a situation whereby the Chinese tech stocks are, they are cheap. The policies are supportive now, right? And there's this funds flow from other, other regions coming back again. So I think, instead of being too engrossed with what actually happens with this US rivalry and the negative impact on these sectors, why not we actually consider that what if this situation actually stabilizes, and then some of these stocks that have actually sold off to such levels could actually have a rebound. Yeah, so I think there's actually a case to be made that there are actually values, good value or good opportunities in the, let's say, in the Chinese tech space.
Thank you for answering that last question. And we've got a lot more coming in, but thank you again for everyone for participating, and Yuin for always sharing your key insights related to this. Now, just to round up our entire session today, we talk about selectiveness and having a strategy, right, going forward into the next year. Now, if you were to give me one key takeaway for our audience watching, what would it be?
I think the key takeaway from me would be that no matter the situation out there, there are always opportunities. So it's just for you to actually to uncover. So do your homework, and hopefully you also would uncover some gems out there.
Thank you so much, Ian, for joining us. And really, you shed a lot of points in your presentation. I think that was a great way to end, but maybe just to recap, could you just give me one last important point that you shared in your presentation just now?
My presentation, I guess would be that there are opportunities out there. You could actually look at Japan, China, and Singapore equities.
Mm-hmm. All right, it's Lim Yuin, everyone, who is the Chief Investment Strategist from Lion Global Investors LGI. Thank you so much, Lim Yuin, for joining us today.
Thanks for having me. Thank you.
Thank you, as always. And I'll see you for the next show. And hopefully that'll be next year. And we can start off, hopefully, with a better outlook as well.
Okay.
Thank you.
You.
And to the audience watching, as usual, this is just a wrap up of show 4, but we've got upcoming shows happening for the entire week. So I think it's important that you rewatch whatever you heard from Yin today, and also all the previous shows that we had. They're all online, they're on the app, they're on our YouTube. So go check it out. The information is there for you. The content is there. So you should use it for your own educational purposes, and learn as much as you can. But if you have any further questions for Yin or even our team, do be sure to even just email us, or just send a message on any of the channels that we have available, and the team will get back to you as soon as they can. So to keep up to date for these shows, make sure that you connect and follow us. You can scan the QR code if you want to find out more information related to the funds or to the webinar series. Okay, and we've got a lot of main shows and fun educational content for you, but you have to follow our social channels, because that's where we are the most active for updates, for live links. If you want to know what's the new campaign ongoing, or even any of these shows, who did we interview, the most recent on our shows, I'm not telling you. You're going to have to find out for yourself by scanning the QR code right here. And it's really a lot of information there. So I think you should go check it out for yourself, and have a good laugh also at some of the content. It's more edutainment for yourselves. And of course, the World Cup fans, if you're interested, these are the campaigns ongoing at the moment, something a bit more educational and fun. And I think you should check out also our social media pages if you want to find out more about the World Cup campaign. And hopefully your teams are doing well as well for this. But more importantly, it's really about joining you on that fight against inflation with this 5%. So I think you should check out if you're interested in finding out more information on how you can implement this into your portfolio strategy. Okay, so more details about next show. We'll see you tomorrow back here online, not just in app, but on YouTube. We'll be covering healthcare and technology outlook with BlackRock. And if you want to watch the replay with Yin today from LGI, you can watch this on YouTube on in app, because there's a lot of information in there. And I think it's worth rewatching that to see what else you can gain, or whatever you missed out. Okay. All right. So with that, I would like to go into the final giveaway for today. Okay. So for those of you who joined midway or missed out the whole quiz entirely, here's the question for you. Top 5 people to answer the question right, you'll get to walk away with this. And I left it for the end because I wanted to surprise you and see, who is staying till the end and who remembers the information that they learned from today. So for those watching, I hope you can get this right. Question 3, please. Is it true that short duration bonds outperform the long duration bonds during rising interest rates? In 3, 2, 1, go. True or false? True or false? Let's go. Great, we've got our winners. Congratulations. The correct answer is true for this case. Congratulations. The team will be in touch, okay? So remember, we'll see you for the next show tomorrow. Thank you once again for joining us. We're wrapping up today's series, but we'll be back here tomorrow fresh and ready to tackle a new topic for you and key expert analysis. We'll see you tomorrow. Signing off, I'm Olivia Higgins.